I want you to look at what is happening in the oil market as if you were looking at a machine, not a headline, not a political argument, not a conspiracy. A machine, one of America's important allies, has begun stepping away from the system that shaped oil, dollars, global trade, and American financial power for roughly half a century. It is talking openly about selling oil in currencies other than the dollar. At the same time, central banks, the institutions that understand money better than almost anyone else because they create it, are buying gold at a pace that should make any serious investor stop and think. Most people will miss what this means because they will look at each piece separately. They will look at oil as oil. They will look at gold as gold. They will look at the dollar as the dollar. They will look at China, the Gulf, BRICS, Russia, India, and central banks as separate stories. That is not how the world works. In my experience, the biggest changes in markets happen when several parts of the machine start moving together. When money, power, energy, debt, and confidence all shift in the same direction. You are no longer looking at a small event. You are looking at a change in the structure. And when structure changes, portfolios that were built for the old world can become fragile very quickly. The first principle is simple. You must understand the system before you try to profit from the system. The second principle is just as important. When powerful players begin changing where they hold their reserves, how they settle trade, and what they trust as money, you should not dismiss it. You should study it carefully. The third principle is the most practical. You do not have to predict the end of the dollar to understand that the dollar's monopoly can weaken. And if a monopoly weakens, capital moves. When capital moves, assets reprice. That is what I want you to understand. The starting point is the petrodollar. Most people have heard the word. Very few people understand the mechanics. They either treat it like a secret agreement that controls everything, or they dismiss it as internet drama. Both reactions are mistakes. The petrodollar system was not one simple contract with one clean expiration date. It was a set of understandings, incentives, and strategic arrangements that emerged after the oil shock of the 1970s. In 1974, the United States was dealing with the consequences of an energy crisis. Oil prices had surged, gas lines were visible across America. The economy was under pressure. Inflation was becoming a political and financial threat. The United States needed a stable relationship with the countries that controlled a very large share of the world's oil supply. So the United States built a bargain. It was not just about oil. It was about oil security, debt, and dollars. The first piece of the bargain was that oil would be priced in dollars. If countries wanted to buy oil, they needed dollars. If Japan needed oil, it needed dollars. If Europe needed oil, it needed dollars. If an emerging economy needed energy to industrialize, it needed dollars. That created steady global demand for the American currency. The second piece was that the oil exporters, especially the Gulf producers, would take the dollars they earned from selling oil and recycle them back into the United States financial system. They would buy Treasury securities. They would buy American assets. Their oil revenue would become American financing. That meant the United States could borrow more cheaply than it otherwise would have been able to borrow. The third piece was security. The United States provided military protection, political support, weapons, and strategic backing to the Gulf monarchies. The arrangement worked because each side received something important. The oil producers received protection. The United States received demand for dollars. The American government received a reliable buyer for its debt. The global economy received a standardized oil settlement system, that is the machine. It is easy to underestimate how powerful that machine has been. When the world needs your currency to buy the most important commodity in the world, you have a special advantage. Economists call it an exorbitant privilege, but that phrase is too soft. It means you can run larger deficits. It means you can borrow more cheaply. It means your financial markets become deeper. It means your currency remains central not only because of trust, but because the structure of global trade forces people to use it. That advantage has helped America import goods, finance government spending, maintain military power, and keep interest rates lower than they might have been in a different world. It was not magic, it was plumbing, and plumbing matters. Because when the pipes begin to change, the pressure inside the system changes. Now we have to look at the cracks. The first crack is that oil producers want more freedom. When a major oil producer starts pushing away from the discipline of OPEC, the issue is not only how many barrels it can produce. The deeper issue is whether the old coordination system still has the same power it once had. If a country has invested in the ability to produce more oil, but the organization tells it to produce less, a conflict is created. The country's national interest begins to diverge from the cartel's collective interest. It wants to monetize its own capacity. It wants to serve its own customers. It wants to decide its own future. That is what happens in every long cycle at the beginning of a system. The benefits of coordination are high. Everyone sees the advantage. Everyone accepts the rules because the rules are making them richer or safer. Then time passes, circumstances change, new powers rise, new buyers emerge, new political incentives appear. The old system begins to feel less like protection and more like restraint. When an oil producer says it wants the freedom to produce more, it is also saying something more important. It is saying the old bargain is no longer as valuable as it used to be. The second crack is that the customer base has changed. China is now one of the most important energy buyers in the world. When the largest customer wants to pay in its own currency or wants long-term contracts that reduce dependence on the dollar, oil sellers must consider that request. That does not mean the dollar disappears. It does not mean tomorrow morning every oil contract is suddenly written in yuan, rupees, or some new BRICS settlement unit. That is not how systems change. Systems change gradually. Then suddenly at first one country tests an alternative. Then another does it for a specific transaction. Then another uses its own currency for trade with a friendly partner. Then a payment platform is built. Then the exception becomes a habit. Then the habit becomes infrastructure. Then the infrastructure becomes a rival. This is how power shifts. It rarely announces itself with one dramatic bell. It normally arrives as a series of small practical decisions that, when viewed together, reveal a much larger change. If China buys oil from the Gulf and wants to settle more of that trade in renminbi, that matters. If India makes a payment for oil in rupees, that matters. If Russia, after being pushed out of the Western financial system, builds trade channels that avoid the dollar, that matters. If BRICS countries build or discuss systems that bypass dollar clearing, that matters. Not because any single one of those things kills the dollar, they do not, but because they reduce the forced demand for dollars at the margin. And in markets, the margin is where prices move. The third crack is the reserve question. This is the part that most people miss. The petrodollar system was never only about oil being priced in dollars. It was also about what the oil money did after it was earned. For decades, a lot of that money came back into U.S. debt. Oil exporters earned dollars, then bought treasuries that helped finance American deficits. It helped keep the system balanced. If that recycling mechanism weakens, the consequences are much larger than most people understand. The United States government is already borrowing enormous amounts of money. It needs buyers. It needs confidence. It needs the world to keep treating Treasury securities as the safest and most liquid place to store large pools of capital. If some buyers reduce their appetite, interest rates must adjust. Or another buyer must appear, or the central bank must eventually become a larger part of the financing mechanism. None of these outcomes are cost free. This is why it matters when countries reduce their treasury holdings or diversify reserves. It does not have to be a universal exit. Japan may buy, the United Kingdom may buy, other allies may hold. The treasury market is still deep, the dollar is still central, America still has the largest capital markets and some of the most innovative companies in the world. But the question is not whether the dollar remains powerful. The question is whether its power is becoming less absolute. Those are different questions. A system can remain dominant and still weaken at the margin, and if you are an investor, the margin is enough. Now we have to ask the most important question. If some central banks and governments are reducing dependence on the dollar, where are they going? The answer is gold. That answer is not emotional. It is not old-fashioned. It is not a doomsday fantasy. It is a rational institutional response to a changing risk environment. After Russia's foreign currency reserves were frozen by the West, central banks around the world received a very clear signal. If your reserves are held in another country's system, then under certain political conditions, your reserves are not fully yours. That is a very important concept. A reserve asset is supposed to be a reserve because it is there when you need it. But if it can be frozen by someone else's legal and political machinery, then it is not only an asset, it is also a dependency. Countries learned from that. They did not all say it publicly. They did not all act at the same speed, but their behavior changed. Central banks began buying gold at levels that were historically unusual. The pattern became very clear. Gold was not being bought because someone wanted a shiny object in a vault. It was being bought because it has no counterparty risk. A treasury bond is someone else's liability. A bank deposit is someone else's liability. A foreign reserve held in another country's financial system is dependent on the rules of that system. Gold is different. It is not a promise to pay. It is not a claim on a bank. It is not a software entry dependent on a political relationship. It is an asset that exists outside another party's balance sheet. That is why central banks buy it when trust in financial architecture becomes less certain. The important point is not that gold is perfect. It is not. It produces no cash flow. It can be volatile. It can be sold during liquidity stress. It can sit for long periods doing very little. But in a world of rising geopolitical fragmentation, gold has one characteristic that becomes more valuable. It is not anyone else's liability. That is the institutional lens. When central banks buy gold, they are not acting like retail traders. They are not trying to catch a short-term chart move. They are managing national balance sheets across decades. They are saying, in effect, that the future may require a reserve asset that cannot be printed, frozen, sanctioned, or debased by another country. That is a very different thesis from simply saying gold is going up. I think about this through three forces. The first force is de-dollarization. Again, this does not mean the end of the dollar. That phrase gets used carelessly. It means the world is slowly building alternatives to total dollar dependence. More bilateral trade in local currencies, more oil settlement experiments outside the dollar, more reserve diversification, more central banks asking whether they want all of their wealth exposed to one political and financial system. That is de-dollarization. It is gradual. It is uneven. It is not linear, but it is real. The second force is debasement. The United States has large deficits and a large debt burden. When governments carry very large debts, they almost always prefer to reduce the real value of those debts over time rather than pay them down, honestly, through taxes or spending cuts. They do it through financial repression. They do it through inflation. They do it by making the currency worth less over time. This does not happen because one person wakes up and says, "I want to punish savers." It happens because the system has incentives. Politicians do not like austerity. Voters do not like tax increases. Central banks do not like deflationary collapse. So the path of least resistance is usually more money, more liquidity, lower real rates, and slow debasement. Gold cannot be printed in the same way. That does not make it automatically better than every productive asset, but it does make it a useful hedge against the long-term erosion of currency value. The third force is diversification. The world is fragmenting. Europe is rearming. The Middle East is unstable. China and the United States are competing across trade, technology, currency, and military power. Energy routes are becoming strategic choke points. Again, countries that once assumed globalization would make everything smoother are realizing that supply chains, payments, reserves, and commodities are all geopolitical tools. When the world fragments, concentration becomes riskier. If a country holds most of its reserves in one currency controlled by one rival power, that is a concentration risk. If an investor holds all wealth in one country, one currency, one asset class, and one assumption about the future, that is also a concentration risk. Gold is one form of diversification. It is not the only one. But when central banks buy it aggressively, the message is clear. The people closest to the monetary system are hedging the monetary system. You should at least understand why. Now, what does this mean for a regular investor? First, it means you should not panic. The dollar is not going to disappear tomorrow. The United States is not a small emerging economy with no institutions and no capital market depth. America still has the world's largest stock market, the deepest treasury market, the most important technology companies, and an enormous military and financial network. Money will still flow into dollars during crises. That is true, but it can be true at the same time that the dollar's unchallenged monopoly is weaker than it was before. The world is not binary. It is not dollar dominance or dollar collapse. It is a spectrum, and the opportunity is often found in the middle of that spectrum, where the old system remains strong enough to function, but weak enough to create repricing in assets that benefit from the shift. Gold is one of those assets. Gold miners may be another. The reason miners can be interesting is simple. They are a leveraged way to express a gold thesis. If the price of gold rises and a mining company has controlled costs, good reserves, competent management, and operating leverage, its earnings can rise faster than the metal itself. But that leverage cuts both ways. A bad miner can destroy capital even when gold does well. Costs can rise, mines can disappoint, governments can change taxes or royalties. Management can dilute shareholders. Operational risk can wipe out the theoretical benefit of owning a leveraged gold play. That is why risk management matters. I never think of an investment thesis without thinking of what can go wrong. That is one of the most important principles in investing and in life. If you are going to own physical gold, you must think about storage, insurance, liquidity, and the spread between buying and selling. If you are going to own a gold ETF, you must think about structure, custody fees, and whether you want paper exposure or physical control. If you are going to own miners, you must think about balance sheets, production costs, jurisdictions, reserves, management, and dilution. The point is not to blindly buy gold because someone said the petrodollar is cracking. The point is to understand the cause-effect chain. Oil settlement changes can reduce dollar demand. Reduced dollar demand can pressure the reserve system. A less trusted reserve system can increase demand for neutral assets. High debt and deficits can increase the probability of debasement. Geopolitical fragmentation can make counterparty free assets more valuable. Central bank buying can validate the direction of institutional behavior. That is the chain. Once you see the chain, you can decide how much exposure, if any, is appropriate for your own portfolio. The right answer is not the same for everyone. A young investor with a long-time horizon and a high income may choose a different allocation than a retired investor living on fixed income. An investor with most assets in real estate may think differently from an investor with most assets in cash and bonds. An investor who understands mining risk may use miners. An investor who does not may use a simpler vehicle or avoid the space entirely. The principle is not to copy. The principle is to think clearly. What I would not do is ignore the behavior of central banks. I would not ignore oil producers experimenting with non-dollar settlement. I would not ignore large changes in treasury holdings. I would not ignore the fact that the countries most exposed to sanctions risk have learned that reserves held in someone else's system can become political assets. And I would not assume that because the dollar has been dominant for my entire lifetime, it must remain equally dominant forever. That is how people get hurt in long cycle transitions. They confuse a long-lasting trend with a permanent law. History shows that reserve systems change. The British pound once held extraordinary power. Before that, other empires had their own versions of monetary dominance. These transitions are slow, complex, and uneven. They do not happen in a straight line. They involve wars, debts, trade shifts, technology changes, and political decisions. They often take decades. But if you wait until everyone agrees the transition is complete, most of the portfolio adjustment has already happened. That is why I pay attention to early structural signs. Not because I want to predict the exact date of anything. I do not think that is possible. I want to understand probability. I want to understand incentives. I want to understand who is buying, who is selling, who is trapped, and who has optionality in this case. The big picture is clear enough. The petrodollar system gave the United States a very powerful advantage. That advantage depended on oil being priced in dollars, oil profits being recycled into U.S. debt, and U.S. security guarantees anchoring the relationship. Now all three pillars are under more pressure than they used to be. Oil producers want more freedom. Major buyers want more non-dollar settlement. Central banks want more reserves outside Western financial control. The United States still has power, but the monopoly is less clean. Gold understands that. Gold is not thinking emotionally. Markets do not think. But prices often reflect the movement of large institutions before most people understand the story. When gold moves with central bank buying behind it, the message is not simply that investors are afraid. The message is that the reserve system is being hedged. That is different. And the smart investor does not ask, "What should I believe?" The smart investor asks, "What is the system doing? And what are the second-order consequences?" The first-order consequence is obvious. More central bank gold buying supports gold demand. The second-order consequence is more interesting. If the dollar's monopoly weakens, dollar-based portfolios may need more real asset exposure. The third-order consequence is that gold miners, royalty companies, and select commodity assets can become asymmetric opportunities if the move continues. The fourth-order consequence is that investors who are overexposed to cash, long-duration bonds, and a single currency assumption may discover that safety was not safety, it was concentration. This is why the lesson matters. You do not need to believe in an overnight collapse. In fact, I think that is the wrong way to think. Overnight collapse stories usually attract people who want drama more than understanding. What you need to understand is that a slow erosion of privilege can create enormous investment consequences. If the world needs fewer dollars at the margin, the dollar's real purchasing power can face more pressure. If the U.S. must finance larger deficits without the same automatic recycling of foreign oil money, the pressure on rates, inflation, or central bank balance sheets can increase. If central banks diversify into gold, gold can become a strategic asset rather than just a speculative asset. If gold rises structurally, some miners and related assets can offer leverage, but only if selected with discipline. That is how I would frame it. No panic, no ideology, no certainty, just cause and effect. When I have studied markets across decades, the people who do best are usually not the people who shout the loudest. They are the people who can separate signal from noise. Noise is the argument about whether the dollar is finished tomorrow. Signal is oil trade slowly becoming more multipolar. Noise is a prediction that gold will immediately go to some dramatic number. Signal is central banks buying gold because they want reserves without counterparty risk. Noise is assuming every miner is a good miner. Signal is understanding that leverage only works when business quality, cost control, and timing work together. Noise is believing America is doomed because the old system is changing. Signal is recognizing that even a dominant power can lose some privilege while remaining dominant in many areas. That is the subtlety. That is where money is made and protected. Because markets often punish people who think in extremes. They punish those who assume nothing will ever change. They also punish those who assume everything must collapse immediately. The truth usually moves between those two positions. So here's the practical takeaway. Study the petrodollar machine. Understand why it gave America such an advantage. Watch the oil producers that want to sell more freely, produce more freely, and settle more flexibly. Watch China, because energy buyers matter. Watch India, because alternative settlement experiments matter. Watch Russia, because sanctions change the psychology of reserves. Watch central banks, because they do not buy gold for entertainment. Watch U.S. deficits, because debt and debasement are linked. Watch gold not as a superstition, but as a balance sheet asset with a very specific role in a fragmented world. And if you choose to act with sizing, diversification, and risk controls. A good thesis can still become a bad investment if the position is too large. A strong macro idea can still hurt you if the vehicle is wrong. A correct long-term trend can still punish you if you buy the wrong asset at the wrong time with no plan. That is why principles matter more than excitement. I would rather be roughly right with a resilient portfolio than dramatically right with a fragile one. The world is shifting. The old oil dollar, debt recycling machine is not gone, but it is under pressure. The countries that understand money are diversifying. The countries that sell energy are exploring alternatives. The countries that buy energy are trying to reduce dependence. The United States still has immense strengths, but it no longer operates in a world where everyone has no choice but to use the same pipes forever. When pipes change, flows change. When flows change, prices change. When prices change, wealth moves. Most people will notice only after the move becomes obvious. They will see gold higher and ask why. They will see the dollar weaker and ask what happened. They will see oil priced differently in more contracts and ask whether it matters. They will see central banks with more gold and assume it was always obvious. But it was not obvious to those who did not study the machine. That is why I want you to think like a mechanic, not like a spectator. A spectator watches the price, a mechanic studies the system. If you understand the system, you can prepare before the crowd. And that is the difference between being surprised by history and being positioned for it.